What if the biggest copper crash in 18 months is actually the best thing that could happen to your portfolio? I know how that sounds. Copper just hit $5.82 a pound. That's a brutal drop. The financial press is screaming about Fed hawkishness and institutional deleveraging. BlackRock's TCP Capital Fund just posted a 19% quarterly loss. Everyone's running for the exits. But here's what nobody's talking about. The price you're seeing on your screen isn't real. Let me explain what I mean by that. There are two copper markets. There's the paper market, futures contracts, ETFs, all the stuff that trades electronically. Then there's the physical market, actual copper cathodes being loaded onto ships and delivered to factories. Right now, those two markets are telling completely different stories. The paper price is collapsing. But the physical premium, the actual cost to get copper delivered to your facility, is staying elevated. That's not normal. In a real oversupply situation, both should drop together. So what's actually happening here? I spent the last week digging through SEC filings, LME warehouse data, and operational reports from mining companies. And what I found is a story about artificial pricing, geopolitical chess moves, and a supply crisis that's being masked by short-term liquidity problems. Let's start with the liquidity issue, because that's what everyone's focused on right now. Kevin Warsh got nominated to the Federal Reserve in January. The market immediately priced in a higher-for-longer interest rate scenario. The dollar strengthened. Commodities got hammered across the board. Standard stuff. But here's where it gets interesting. Large institutional funds weren't just selling copper because they thought demand would weaken. They were selling copper because they needed cash immediately. BlackRock's TCP Capital is a perfect example. They're a credit fund. They got destroyed in their core holdings. But copper futures are liquid. You can sell them today and have cash tomorrow. It's what traders call a collateral chain reaction. You sell the thing that's easiest to sell, not the thing that makes the most fundamental sense to sell. Think about that for a second. The price of copper is dropping not because there's too much copper, but because hedge funds need to cover losses in completely unrelated markets. The metal itself has nothing to do with the sell-off. Now let's talk about what's actually happening in the physical world. September 2025. Grasberg mine in Indonesia, second largest copper-gold deposit on the planet. A massive mud rush forces them to declare force majeure on long-term contracts. That's a legal term that means we physically cannot deliver what we promised you. As of right now, Grasberg is operating at 65% capacity. Freeport-McMoRan says they'll get back to 85% by Q4 2026. But I looked at the independent geotechnical reports. Some analysts think the damage is structural. They're saying sub 70% capacity until 2027. Do we really believe that's not going to affect prices? Here's the part they are telling you. Grasberg wasn't the only problem. Cobre Panama shut down permanently in 2024. Chilean mines like Escondida are dealing with declining ore grades because they're old. They're extracting less copper from the same amount of rock. Meanwhile, demand is accelerating in ways most analysts aren't accounting for. Everyone knows about electric vehicles. That's the standard story. EVs need more copper than traditional cars. Fine, but there's a bigger shift happening that almost nobody's pricing in. AI infrastructure. A traditional data center rack uses 10 to 15 kilowatts of power. An AI-optimized rack with H100 or B200 GPU clusters uses 60 to 100 kilowatts. That's not a 20% increase. That's 6 times more power density. And power density means copper density. You can't move that much electricity without massive bus bars and heavy gauge wiring. A single 100 megawatt AI facility requires approximately 50,000 tons of copper. A legacy data center of the same size, about 15,000 tons. The International Copper Association is projecting 22% year-over-year growth in AI-related copper demand. They're forecasting a 35% compound annual growth rate through 2030. I looked at the data, and something doesn't add up. If AI demand is growing that fast, and supply is constrained by mine closures and operational problems, why is the price dropping? Because the market is looking at the wrong signal. It's watching BlackRock's fund losses and Fed nominations. It's not watching warehouse inventories or physical delivery premiums. Here's another piece most people are missing. In late 2025, the U.S. Treasury added copper to the critical minerals list. That's a big deal. It means the government has officially recognized that domestic energy transition and what they're calling AI sovereignty are impossible without secure copper supply. And then there's the tariff. January 2027. The U.S. Trade Representative is implementing a 15% tariff on refined copper imports. Right now, it's 0. In less than a year, it jumps to 15%. If you're an industrial buyer, Tesla, Siemens, Nvidia, what are you doing right now? You're stockpiling. You're locking in contracts at $5.82 a pound because you know that in 11 months, that same copper is going to cost you 15% more if you import it. That creates a weird dynamic. Short-term selling pressure from hedge funds, long-term buying pressure from industrial users. The price is being suppressed by financial engineering, while the physical market is tightening. Let me give you an analogy. Imagine you're playing poker. You've got a strong hand, but you're short on chips because you lost the last few rounds. You're forced to fold, not because your cards are bad, but because you don't have enough chips to stay in the game. That's what's happening to copper right now. The fundamentals are strong, but the financial system is forcing sellers to liquidate, regardless of fundamentals. Now let's talk about who benefits from this. Freeport-McMoRan controls Grasberg. They also have the largest domestic copper production in the U.S. When that 2027 tariff hits, their U.S.-based production is exempt. They'll be able to sell at elevated prices while foreign competitors get hit with the 15% tariff. But here's the controversial part. Freeport has an incentive to manage the Grasberg recovery slowly. If they bring production back online too fast, prices drop. If they drag it out, prices stay elevated while they transition to underground mining. I'm not saying they're deliberately sabotaging their own mine, but the incentive structure is there. And in markets, incentives matter more than intentions. There's another player in this game that nobody's talking about. Chile and Indonesia. As copper prices rise, these governments are implementing what some analysts are calling modern confiscation. They're not nationalizing the mines. They're just raising royalties and windfall taxes. If copper hits $7 or $8 a pound, they'll capture a bigger share of the profits through taxation. It's a smart move politically. They get to fund social programs without the mess of actually running mining operations. But it creates uncertainty for investors. Here's where it gets even more complicated. There's a legitimate counter-argument to the bullish case. Some analysts think aluminum substitution could cap copper prices. If copper stays above $5.50 a pound for too long, manufacturers might switch to aluminum for wiring. Aluminum is only 60% as conductive as copper, but it's significantly cheaper and way more abundant. Bloomberg NEF published a report suggesting this could happen at scale if prices stay elevated. I spent 3 hours digging through the technical specifications to figure out if this is actually feasible. Turns out, it's complicated. You can use aluminum in some applications, but for high-power density systems, like those AI data centers I mentioned, aluminum doesn't work. You need copper's conductivity. So the substitution threat is real for low-intensity applications. But for the fastest-growing segment of demand, it's not an option. There's also the China question. If China's property sector doesn't recover, does AI demand just fill the hole left by construction? In that scenario, you don't get a price moonshot. You get flat prices, with demand shifting from one sector to another. That's a reasonable concern. But here's what the data shows. Chinese construction demand peaked around 2018. It's been declining since then. AI infrastructure demand is just starting to ramp up. Even if China's property market stays dead, global AI build-out is additive, not substitutive. And then there's urban mining. New recycling technologies are improving copper recovery from old electronics. Some estimates suggest this could add 1.2 million tons of supply by 2028. But think about the scale. Global copper consumption is around 25 million tons per year. Adding 1.2 million tons from recycling helps, but it doesn't solve a structural deficit. Let me tie this together. You've got a situation where the visible price is being driven by short-term financial stress. Hedge funds are dumping copper to cover losses elsewhere. The Fed is signaling higher rates. The dollar is strong. All of that creates selling pressure. But underneath that, the physical market is tightening. Mines are offline or operating below capacity. AI infrastructure is creating unprecedented demand. The US is implementing tariffs that will fragment the global market. The headlines said copper is crashing. But the reality is you're watching a liquidity-driven correction in a market with deteriorating fundamentals on the supply side and accelerating fundamentals on the demand side. So what happens next? If I'm right, we're looking at a 12 to 18-month window where the paper price stays suppressed while the physical market continues to tighten. Then something breaks. Either a major buyer can't get physical delivery and has to bid up the price, or Grasberg's recovery takes longer than expected, or China announces a massive AI infrastructure program. Any one of those catalysts could push copper past $7 a pound by late 2027. But here's the uncomfortable part that nobody wants to admit. If prices do spike that hard, there's a real risk of government intervention. The US could implement windfall taxes on domestic miners to keep inflation down. We've seen that playbook before with oil in the 1970s. So even the bullish case has political risk embedded in it. If you're looking at this from an investment perspective, the play isn't to go all in on copper futures. Those are still going to be volatile in the short term. The play is to look at miners with low all-in sustaining costs who benefit structurally from the 2027 tariff. Freeport-McMoRan is the obvious one. They control Grasberg and have domestic U.S. production. AIC Mines is more speculative but interesting. Their Jericho project in Queensland has 2% copper grades. That's nearly double the global average. First ore is expected in June 2026. But here's the question I keep coming back to. If this is such an obvious setup, why isn't the market pricing it in already? Maybe the market is smarter than I am. Maybe aluminum substitution happens faster than anyone expects. Maybe China's demand collapse is deeper than the data suggests. Maybe Grasberg comes back online ahead of schedule and floods the market. Or maybe the market is just looking at the wrong thing right now. Maybe it's watching BlackRock's quarterly loss and missing the fact that AI data centers are being built at an unprecedented pace. I don't have a crystal ball, but I know this much. When the paper price and the physical price diverge this dramatically, something's wrong. Either the fundamentals are broken or the price is broken. And right now, I think it's the price. So here's what I'm watching. LME warehouse inventories. If those start dropping significantly while the paper price stays low, that's your signal. Physical delivery premiums in China and Europe. If those keep rising while futures fall, that confirms the divergence. And Grasberg's production numbers. If they miss their Q4 2026 target, this whole thesis accelerates. The market is giving you a discount on a structural deficit. The question is whether you believe the discount is real or artificial. What do you think happens when the liquidity crisis ends, but the supply crisis doesn't?